All right, as it's 1 o'clock, I think we can get started. Welcome, everyone. Thank you so much for attending our next webinar. Today, we'll be discussing what you need to know about the CARES Act, what tax provisions there are, and what programs are available. As a reminder, the Q&A section is open, so please feel free to ask any questions you may have, and we'll address them as soon as possible. Today, we're going to have 4 key members of Janover presenting. We're going to have Mark Goodman, Managing Partner, Joe Tanser and Mindy Kamen, also partners at Janover, and Gianluca Carabs, a Senior Tax Manager. So I just want to give them each an opportunity to introduce themselves and just give a little bit of the background and just some of the interesting things they've seen to date as it relates to the CARES Act. So Mark, I don't know if you want to lead us off quickly.
Good afternoon, everybody. Thank you for being with us. We know these are unprecedented and challenging times, and we are going to do our best to make them a little bit less challenging and give you the information you need to succeed and thrive, or at least survive for your business and during these times. I am the managing partner of the firm, and I've been in this role for almost 20 years now, and we've been working with many clients in the middle market here in New York. But our clients are really large and small. They're entrepreneurs. They're people who appreciate the balance and the ingenuity that we bring to the situations. So we welcome you to be here, and we're glad you joined us. And I'm turning you back over to Zach now.
All right, thanks, Mark. Joe, just a quick introduction, please.
Yes, hello, good afternoon. I'm Joe Tanser, and I've been studying the Paycheck Protection Program, the PPP loan, which has been quite the talk of the town lately. And I hope to be able to provide some insight as to how the program works, whether it might be a suitable fit for you or your company. You know, the things you must consider in making an application and dealing with the use of the funds, and in order to get the best possible use of it, which would hopefully turn out to be a grant. So with that said, I'll turn it back to you, Zach.
All right, thanks, Joe. Mindy, a quick introduction.
Hi, I'm Mindy Kamen. I've been with the firm for about 17 years. Regarding the CARES Act, I'm going to be focusing more on the tax side. So I'm looking forward to give you guys some answers to all your questions. Back to you, Zach.
Luca?
Hi, my name is Gianluca Carabs. I'm a senior tax manager with over 10 years experience. I've been with the firm for a little over 2 years. This pandemic has created a significant amount of challenges and opportunities from a tax perspective, and we're here to help everybody. Back to you, Zach.
Right, thank you, everybody. So just as a matter of bookkeeping, we do have to make sure that everyone is understanding that we're not giving any specific advice. Nothing should be taken as advice, and as such, if you have any specific questions that maybe you don't want to address in a forum like this, we'll have all of our contact information available. Please feel free to reach out. So why are we here today? What are we here to discuss? We're going to go through the CARES Act, what it is, what are the key provisions, what do you need to know? How can you actually take advantage of the CARES Act? How can you help your business? And then again, dive into a bit on the tax side, what can be done and what are the next steps. So with that, I'd love to turn it over to Mark, who can just walk us through what is the CARES Act. Mark?
The CARES Act was a piece of revolutionary, and I don't use that word lightly, law that was signed into place by Congress and approved by the President on Friday, March 27th. It provides relief to individuals and businesses that have been negatively impacted by the COVID-19 outbreak. It is literally the first of its kind that this type of act. You have to go back to the Great Depression and the New Deal to see government programs of this size being directed to our economy, and never before has it been directed like this to the small and mid-sized business community. Most programs in the past have been directed to individuals or to specific industries who've had problems like the bailout of the automakers in 2008. Never has there been a global act like this from our government benefiting the small and middle market. I also want to caution people. I know a lot of people have already are listening in, they're looking for advice, and they've applied for loans under the PPP, the Paycheck Protection Program that is going to be discussed in more detail by Joe Tanzer. We have literally thousands of clients at our firm. While many have been successful in the submission of their application and that they've been told by their lending institution it has been passed on to the Small Business Administration, we are not aware of one client that has been funded yet. So I just caution everybody to please have a degree of patience. It is my understanding that the SBA typically processes about 60,000 loans in a year, and they're literally being asked to process millions of loans in the course of a week. And it is overwhelming the system. It is overwhelming the banks. The banks that are doing this are not, who are doing most of the processing, are not SBA lenders, and they typically don't have experience in this area, and everybody is trying to figure this out on the fly. Rules are not clear at times. Joe will get into more detail on some of the items that have gone through where rules and decisions were put out or interpretations were made only to have them contradicted either by the banks, by the SBA, by the US Treasury. So there are a lot of moving targets. It's very important that you stay informed. It's very important that you communicate with your advisors like us here at Janover to understand what is going on. We're reaching out to all our clients on a regular basis, on a very consistent basis, and trying to speak with them no less than weekly and sometimes daily. But if you have questions, please don't wait, reach out and ask for help.
All right, thanks, Mark. Now, we've mentioned some of the SBA loans that are available. We've mentioned the CARES Act. Is there anything for New York City specifically that we can talk about here?
Okay, well, if you can flip to the next slide, in addition to the Paycheck Protection Act, which Joe is going to talk about, and the EIDL loans, which are also going to be talked about, there are a couple of interesting programs in New York City. There's a New York City interest-free loan for businesses with fewer than 100 employees, with all locations in the 5 boroughs. You can apply for up to $75,000. You must demonstrate a 25% revenue reduction for 2 consecutive months, as compared to the average revenues for 2019 or the same 2 months in 2019. And you have to have been in business for 2 years. So this is something nice. It's particularly for you know, if a restaurant or or a hotel or anyone else that's needs the money, this can be in addition to all the other programs if they're based in New York.
Now, can you give an example of maybe some documentation or support that would be required to prove that there's a 25% reduction in revenue?
I would think it would be pretty simple, and probably just a financial statement prepared by your company, or if most of your money comes in from credit card statements, you might even be able to just show the credit card income to do or show a P&L just showing the revenues, comparing revenues, say for March and April or February and March of 19 versus 20, and then with credit card statements to support the revenue or whatever sources you have to support. You know, you'll have to go to the NewYorkCity.gov website. Has these links and we'll explain it much better. You know, we have not been involved in these loans per se with our clients other than to advise them on it. So we're really not sure of what specific information they would require, but it's our experience with most of these things that if you provide a reason, they're not looking for audited numbers. They're not looking for even accountant determined numbers. internal numbers are fine. They just have to be reasonable in supporting what you're doing. Some of the support isn't even necessarily required at certain levels, but the banks are requiring it for their own comfort. Speak with whoever you're talking with, read the items that they're requesting, put together reasonable support, but do not worry about having to have a level of detail that you typically might have in other loan situations, because this is moving too fast, and they know companies need the money, and they don't always have access timely to the information that they might need. For example, it might take time for a company to demonstrate all the backup for the 2-month period right now.
Very good point. And then there's another program I think you wanted to mention.
Yeah, just quickly, New York City Employee Retention Grant Program. This is nice. This is for very small businesses with 1 to 4 employees in New York can apply for a grant. So if you for 40% of employee payroll for 2.5 months, you must demonstrate again the same reductions, and be in business for just 6 months. And this can be used in conjunction with the PPP, with the payroll protection program.
Perfect. And that is actually a perfect segue into the next section. So Joe, can you please take us through what is the PPP and why is it such a talk of the town right now?
Well, as I'm sure everybody knows, on March 27th, when this CARES Act was passed, people were sort of in a panic, and the federal government was extremely sensitive to this, so much so that Congress felt the need to get an emergency package out. And the word emergency, I think, is fitting here in the sense that there was a need for it, but also they acted very quickly, is what most people do in an emergency. So Congress created a program to be able to get into the hands of people who really needed it, $349 billion of loans that could potentially turn into grants for what they called small businesses. And as Mark pointed out, that small business definition has been expanded, and I certainly want to talk about that. But I also want to point out that in their rush to get this package through, they weren't as careful as they usually are in writing law. And so what has happened, also, as Mark pointed out, there's been a lot of different interpretations of the law. And depending upon whom you ask, whether it's the banks or the SBA itself, other professionals of different degrees, CPAs and attorneys and other advisors, you're going to get very different answers. So what you hear, partially when I speak today, is going to be pretty much the Janover position that we've come to. We have felt that our language is most consistent with the law, most consistent with the recent publications that came out from the SBA. But you know, obviously there is room for interpretation. Otherwise, so many professionals would not be saying different things. So, you know, naturally you need to speak to your own particular advisor. Obviously, people at Janover that you're working with can help you in this area. We on the panel will try to help you as much as possible in the Q&A that we have. But in any case, I wanted to point out what was behind it. There is definitely a lot of different interpretations on this. So as I mentioned earlier, this was really designed for small businesses as there was a way of marketing this. So who better to go to than the Small Business Administration, which is a federal agency that is set up specifically for making loans to small businesses. But the law was very carefully designed in this respect. They said that we're not going to just use the small business concerns that we have typically done. We're going to expand the definition to be pretty much any business that has up to 500 employees whose principal residence is in the United States. So that included most businesses It included nonprofit organizations under 501c3. It included veterans associations. It even included tribal associations. And the key there is that if you have no more than 500 employees and all the employees have a permanent residence in the United States, you should be able to apply. Whether you get the funds has something to do with timing. As you know, everybody's been rushing to get their applications in because eventually that money could run out. Now government is now talking about adding another quarter of $1 trillion to this, and that would certainly help. But you know, most people were rushing to get this in. So the most that you can apply for under this PPP is what's called average monthly payroll costs, which I'll define for you. And you multiply that by 2.5 times. So what the government was really trying to get to was 2.5 times your monthly payroll. And the payroll, as I said, is not just the gross payroll, but it's a little bit more expanded, but no more than $10 million. So it's, except for very large companies, it's not likely to get to that $10 million mark anyway. And mostly because most people don't have average monthly payroll costs of $4 million. That's what it would be, a $10 million loan. So for the average monthly payroll costs, what payroll costs mean in this context are gross payrolls, and that usually means wages and salaries and commissions. It even includes severance pay or leave pay, except to the extent you're getting a credit back on that leave pay. But your basic payroll. It also includes the health insurance premiums that you're paying for your employees. And it also includes pension plan payments, like to a defined benefit or a defined contribution plan that you have for your employees. And the last component is state and local employer taxes. So first of all, that doesn't include withholding taxes, which was, of course, one of the things that people were arguing about, but that's been clarified. And it also doesn't include anything that's federal. So no FICA, no federal unemployment insurance, no Medicare, just the state and local on that, in that aspect. And so if you add all of that up and you multiply that by 2.5 times, that's the most that you can ask for in a loan. And you'll see when you get to your application, if you haven't already done so, you will see that there are boxes that you fill in for those components, the monthly payroll costs and the 2.5 times equals. And it's relatively simple. But you do have to, of course, submit documentation for this, and that's where you need to make sure you know the components. One of the aspects of this is that you can include no more salary than $100,000 per person. There was a lot of confusion, a lot of debate about whether that 100,000 included all of the costs, including the benefits. In the last production, or I should say publication from the SBA, it was clarified that that only includes the salary. So therefore, the $100,000 salary maximum, you can still add to it the benefits that you have for your employees. So that's the first set of numbers that you really have to work with. The second set is what can you use the money for? So while this was based upon payroll costs, the government actually allows you to use it not only for payroll costs, but also for mortgage interest, and even for interest on other debt that was incurred prior to February 15th. It also allows you to use it for rent and utilities. And one more thing, which is even for health insurance costs for people who are on leave, you can use it for that as well. The one stipulation in this regard is that you must use 75% of it for your payroll costs. And as a reminder, your payroll costs include not only your payroll, but also those other components, the benefits that I mentioned earlier. So that was a big sticking point. Now, supposing you don't have payroll, well, generally speaking, most people would then not be able to qualify for the loan. However, there is a special rule that independent contractors, self-employed people, they can qualify based upon their own income. And if they have employees, then they can throw the employees in as well. Another confusion point for people when they read the law, some people thought that you could use in your payroll costs the monies that you pay to independent contractors. The government clarified that also a week ago by saying that you cannot include in your payroll costs the monies that you pay to independent contractors because they have the right to apply for themselves, and therefore there would be double counting, and the government didn't want to have that. So I hope that clarifies it for some people. What makes this loan special? Well, one of the things you see here on the screen, there are no personal guarantees for this loan. So whereas before the SBA would require that there be personal guarantees, here you do not have to have a personal guarantee. Another thing that is different is that in past, the SBA would require that the borrower would have no other place to get borrowing. So the SBA would be sort of like a last recourse to get money. In this context, though, in the PPP, that's not the case. So even if you're a business that has the opportunity to borrow money elsewhere, you can still apply for the PPP, which is a nice thing. And also you don't have to put down any collateral. So that's another part of this loan that makes it special. Supposing that you use your money properly, in other words, you spend it 75% for your payroll and then also for your mortgage interest, your rent, utilities. The next computation you need to make is for one that's called forgiveness. And by the way, let me just take a step back. In using the money, we've recommended to our clients that they set up a separate bank account for this PPP money. It's not a requirement, but we think it's good policy, mostly because you are only allowed to use it for the costs that I mentioned before. And if you use it for that, then you haven't been in violation of the program itself. And by having a separate account, you should be able to prove that you use the money correctly. And we believe that even if you have a payroll account that's separate, it doesn't make it any different. You should still have the money go into PPP. So this way, let's say you have a payroll account where your payroll processing company is debiting that account. We don't want you to change that arrangement with your payroll company, but we would say that you should have your payroll company take it out of the existing account that you have, and then sweep the money from the PPP account, for lack of a better name, into that payroll account to cover the gross salary and the state and local taxes that you're allowed to put in there. And maybe if they take out the health insurance, you can put that one over as well. And even if they also take out for your retirement plan matching, you should be able to take that out. But we do believe that it should be kept in a separate account. You'll be able to prove that you use the money the right way. And then now, as I'm about to say, you're about to have forgiveness if you have used this money in the proper way and meet certain tests. And that's another reason to have this money in a separate account, because at some point you're going to want to apply for forgiveness, and you're going to want to prove that you use the money in accordance with this program and in accordance with the tests that can be made here to get your forgiveness. There are really two tests, both of which are based on payroll. One is what we call the full-time equivalence test, and the other is a salary reduction test. They get kind of complicated, and I want to try to not give you too much detail, but just on an overall, 8 weeks after you get the money from the PPP, it starts a period by which you're going to make a measurement. The whole idea here is that you spend in the 8 weeks after getting the money enough on payroll so that your workers are not being reduced in some way that is going to be harmful to the economy. So there are tests that are done. One, you're going to look at that 8-week period and see how many full-time equivalents you have working for you during that 8-week period. And that is full-time equivalents really just a way of measuring for people who are not full-time how many full-time equivalents it gets to be how many part-timers it gets to be a full-timer by equivalency. So as an example, if your full-time person is a 40-hour person and you have 2 people working 20 hours, those 2 people combine for 1 full-time equivalent. So that's just a measurement. It's really nothing more than that. But there's a look back to an earlier period right before you got the loan. And that will be, you're going to compare what you have in full-time equivalents versus the base period. And if it's gone down, then you stand to lose some of that forgiveness opportunity. The second test has to do with salary reduction, and that's on a person-by-person basis. So the government wants to make sure that you're paying people in the 8 weeks that follow the loan at least 75% of what you paid them in the base period. And if you haven't paid as much as 75% of that amount, then you stand to lose more forgiveness. So the base periods are kind of complicated. I don't want to get into all the details with that now because to save time. Certainly can answer questions later on if you like. But also I want to point out to you that if for some reason your forgiveness amount is reduced, it's really not the end of the world. All that happens at that point is it turns into a loan. And the loan is repayable, and principal amount is repayable in 2 years. So it's not terrible. And the loan rate is 1% per annum. So again, it's really not a big deal.
To follow up to what Joe's saying, I wouldn't worry a lot about how you're going to use the funds right now. I would focus on getting the funds. We're getting a lot of questions from our clients, and there's been, I'm not aware of any guidance, questions like what happens if we pay, they say an 8-week period, but what happens if you pay for items that go outside of that 8-week period during that 8-week period? What happens if you make a safe harbor payment for the company's retirement plan? What happens if you catch up on back rent? What happens if you pay a bonus to the employees? What happens to related party payments? All these things appear right now okay, but I would expect there'll be certain guidance in the future that'll point us and clarify some of these items as we move forward. But as far as we can tell right now, they're all eligible as long as they are paid during the 8-week program. But we would not be surprised if there are certain clarifications that come forward soon. I would focus. So again, just focus on getting the money right now and then speaking to Janover or your advisors for assistance with this as you move forward.
So
and just one of the other big questions that maybe you can address.
I want to just, yeah, okay, go ahead.
I was just going to say, timelines for getting these applications in. Is it just as soon as possible? What timelines, what cutoffs should they be aware of?
Okay, all right, so I'll answer your question first, and then I want to come back to Mark's point as well. The timeline, naturally, this program actually goes from February 15th to December 31st. And that sounds wonderful, and it will be wonderful especially if Congress adds more money to this. But our concern has been that this money is going to run out. I mean, everybody was applying. I mean, millions and millions of people were applying. In the very first half hour, there were millions of applications already being done. And so we're afraid that money will run out. So my advice normally is take it when you can and use it as best you can. Again, even if you can't have it all forgiven because maybe your payroll has gone down in that 8 weeks, or maybe you can't even return to your workplace because you're in a profession or in some industry where there's no working from in your place of business. Take the money when you can, spend it, and if you can't do payroll for the full amount, then do whatever you can. And then you'll just use it later on. And so you won't be forgiven. You'll just have to defer it, that's all. But it's better to get something than nothing. And that's our position on that one. Going back to what Mark said earlier, which was a great point, I thought. We at Janover obviously have been talking a lot about this program. We talk about it in our partner meetings. We talk about it offline, individually. We talk about it with our clients, obviously. We see this role that we have in helping our clients through this as a three-phase type of program ourselves. Naturally, the first phase of it is to help our clients get the loans. So clients have had many questions about this. We've answered many of them, and we try to work to get to the best answer. Sometimes we don't know it right off the top, and we have to get some help, but we try. And we usually are able to give our clients pretty sound answers. And it so happens that most of where we came from is very consistent with the way that the law was written, and also as it has been interpreted by the SBA itself. The second phase of this program is to help our clients in the use of the money. So one of the things that Mark was talking about is we have certain choices, and how do we best use it? And we're looking to use it, first of all, in accordance with the agreement that's made, which means that you have to use it only in certain ways, but also with the aim to trying to maximize the forgiveness effectively to get the largest grant out of this. The third, and what we see as the final phase, will be the application for the forgiveness itself. At some point, there will be another application period that we need to ask for forgiveness and document everything that we've done. So
It's my understanding that's going to be 60 days from the end of the 8-week period, I think. You're going to have to submit that.
my understanding.
I thought I saw something on that.
So, but certainly it should be after the 8 weeks for sure. And, one of the things you might do, because there's a provision for getting some of that forgiveness back by rehiring people by June 30th, it's possible that, you want to maybe let June 30th pass to see if you can reinstate some of the money that was not forgiven up to that point. So yeah, so it would make sense, whether it's 60 days or 30 days, we'll have to see. But that's probably just a good thing to do.
And we'll follow up with you and let all our clients know through our email blasts and through communications. But I know the time limit for applying for the grant portion is going to be fixed and limited. And again, I think it's 60 days. So if you don't file within that period, it'll just stay as a loan. But if you're going to want the grant, you're going to have to file timely within the period.
All right, I'd like to turn this over. We have 2 more speakers, so I think I've spoken enough.
Well, Joe, just quickly, there's a couple of other programs we just want to very high level talk about. Do you mind just very quickly going through the EIDL just so people are aware of it?
Actually, I thought that one of our other speakers was going to address this. But I mean, basically what you see on the screen, there's a special emergency loan called the EIDL. Most people are getting a $10,000 request, which becomes a grant. This one requires a little bit different documentation. You have to, generally you have to produce documentation about your revenues, your cost of goods sold, and you want to be able to show that you have a difficult time here. And then, as you see on the screen, that you need a personal guarantee if the loan is over $200,000. So it doesn't have all of the freedoms that you have with the PPP, but it's quick money, and you can use the money as you see fit, which is you're not subject to restrictions. So that's kind of nice.
All right, great. Thanks, Joe.
Sure.
Now I'd like to turn over to Mindy, who's just going to talk a bit about some of the tax provisions that are available.
Yes, so before we get into the CARES Act, I just want to mention some automatic filing and payment extensions. So the federal income tax filing due date is automatically extended from April 15th to July 15th, 2020. Taxpayers can also defer paying their income tax payments due on April 15th to July 15th without penalties and interest, regardless of the amount that is owed. This applies to all taxpayers, individuals, trusts and estates, but only estates filing Form 1041, corporations, other non-corporate tax filers, as well as those who pay self-employment tax. The first quarterly IRS estimated tax payment for 2020 is also postponed from April 15th to July 15th. And at this time, the second quarter 2020 IRS estimated tax payment is still currently due on June 15th. So hopefully the IRS will come up with additional guidance regarding the second quarter estimated tax payments. As of now, non-income tax returns such as payroll taxes and excise taxes have not been extended. Estate tax returns, which file Form 706, have not been extended. Taxpayers who have filing or payment due dates other than April 15th have not been granted relief at this time. For example, foundation returns are still currently due May 15th. States are sporadically conforming to the federal tax filing and payment deadline of 7/15 for 2019 tax returns. So our firm's been up to date on that, looking at each state, whether or not they extended or not. Also for New York State, if sales taxes couldn't be filed and the liability couldn't be paid by March 20th, the penalty and interest may be waived for quarterly and annual filers who are unable to file or pay on time due to COVID-19. Returns must be filed and the amount due must be paid within 60 days after March 20th in order for the client to apply for the relief. So now let's get into some of the provisions in the CARES Act for individuals. So the first provision I'm going to talk about is the 2020 recovery rebates. Now, the IRS is calling the 2020 recovery rebates in the CARES Act economic impact payments. The potential payment that can be received is $1,200 for individual or head of household filers and $2,400 for married filing joint taxpayers. In addition, taxpayers are eligible for an additional $500 per qualifying child. So if you look at the chart real fast, we'll take married filing joint as the example. So if a taxpayer who files married filing joint adjusted gross income is $150,000 or less, they're going to get the full rebate amount of $2,400. If their AGI is between $150,000 to $198,000, their rebate is going to be reduced. The amount of the reduction is $5 for each $100 that are above the AGI thresholds. And then if the AGI is over $198,000 for married filing joint, no rebate will be received for that taxpayer. Taxpayers are not eligible for the rebate if they could be claimed as a dependent on someone else's return, they do not have a valid social security number, and they are non-resident alien. If a 2019 or 18 return was already filed, no additional action is needed by the taxpayer. If a taxpayer already filed their 19 return, the IRS will use the information to calculate the payment amount. If a taxpayer hasn't filed their 19 tax return yet, but filed an 18 federal tax return, the IRS will use the information from 18's filing to calculate the payment amount. As of March 30th, the IRS announced that the payments will begin to be made within the next 3 weeks, so let's see what happens. The IRS also plans to mail letters out to taxpayers about the economic impact payment, and they'll be sending those letters to the last known address within 15 days after the payment is made. The letter will provide information on how the payment was made and how to report any failure to receive that payment. So let's jump to retirement funds. So contributions can be made to your IRA at any time during the tax year or by the due date for filing your return for that year. Because the due date for filing federal income tax returns has been postponed to July 15th, the deadline for making contributions to your IRA for 19 is also extended to July 15th, 2020. So you still have some time to make those IRA contributions. Normally, early distributions from a qualified retirement plan is subject to a 10% early withdrawal penalty. Under the CARES Act, if an individual or their family member have tested positive with the coronavirus or experienced financial hardship for reasons of being quarantined, furloughed, being laid off, having reduced hours, etc., they could take up to $100,000 from their retirement plan and not be subject to the 10% early withdrawal penalty. The taxpayer can elect to report the distribution over a 3-year period or repay the distribution back to the plan within 3 years. Also, an owner of a retirement plan or IRA is required to take minimum distributions, RMDs, annually once the owner reaches age 72. Under the CARES Act, the RMD requirements do not apply for calendar year 2020. So for those who have already taken their 2020 RMD within the past 60 days, you can redeposit those funds back into the IRA account with no tax consequences. This doesn't apply if an RMD was already taken from an inherited IRA. Now, charitable contributions. So this is something new too that's been added in the CARES Act. So the CARES Act provides an above-the-line deduction of $300 for charitable contributions, thus providing a benefit to taxpayers that are unable to itemize their deductions for taxable years beginning in 2020. So taxpayers that file using the standard deduction, they'll get this additional $300 deduction on their 1040 for 2020. Also, prior to the CARES Act, an individual qualified cash contributions to certain charitable organizations were limited to 60% of adjusted gross income. And for corporations, the charitable contributions were limited to 10% of modified taxable income. Any excess contributions were then carried forward up to 5 years. Under the CARES Act, for taxable years ending after December 31st, 2019, the 60% AGI limitation for individuals and the 10% limitation for corporations has been removed. So therefore, you can make qualified cash contributions with no limitation. And I want to emphasize cash because you cannot make non-cash or stock contributions. Those will still be subject to the limitations for AGI. Donations to a supporting organization or donor-advised funds are not considered qualified contributions. A supporting organization is a charity that carries out its exempt purposes by supporting other exempt organizations, usually other public charities. A lot of our clients set up donor-advised funds. So according to the CARES Act, if someone puts cash into a donor-advised fund, they will not be able to take the full 100% deduction if their AGI, it's based on the regular AGI limits of 60% if you donate to a donor-advised fund. Now I'm going to discuss some business tax provisions related to the CARES Act. So the first one is the employee retention credit. This is not available to those small businesses that are receiving small business interruption loans under the Paycheck Protection Program. So this is something that we just wanted to highlight to everyone and let them know if you're getting a loan under the PPP, you are not eligible for the employee retention credit. A refundable payroll tax credit of 50% of wages, which is limited to $10,000 per employee, is allowed for small businesses whose operations have been fully or partially suspended as a result of a government order limiting commerce, traveling, or group meetings. The qualified wages must be paid between March 12th, 2020 and before January 1st, 2021. In computing the wages eligible for the credit, all wages are included for employers with 100 employees or fewer. For those employers with greater than 100 employees, only employee wages eligible for the credit includes those employees that have been furloughed or face reduced hours. Small businesses are eligible for the credit also if its quarterly gross receipts experience a 50% reduction when compared to prior year's similar quarter's revenue. So we have to compare first quarter of 2020's revenue with first quarter of 2019's revenue. The same thing, you would compare second quarter of 2020's revenue to second quarter of 2019's revenue. The refundable credit is capped at $5,000 per employee and applies against certain employment taxes on wages paid to all employees. Eligible employers can reduce federal employment tax deposits in anticipation of the credit. So if you're not taking the PPP loan, please reach out to your payroll tax provider and discuss this option with them. The last section I'm going to talk about is the delay of employer payroll taxes. So this is not available to any employer that has any portion of an SBA loan forgiven. The deposit of the 6.2% employer portion of FICA, which comes due between March 27, 2020 through December 31st, 2020, can be deferred and paid to the IRS as follows. 50% of the employer portion of the FICA taxes would be paid December 1st, 2021, and the remaining 50% of employer portion of the FICA taxes would need to be paid by December 31st, 2022. In addition, the self-employed will be entitled to estimated tax relief if relying on this provision. I just want to point out that this is only for the 6.2% FICA. You still have to pay the required Medicare tax. And I guess I'll pass it on to Luca, who's going to talk more about the business taxes.
All right, thanks, Mindy.
Thanks, Mindy. Zach, thank you. So the next aspect, I'm going to be jumping around a bit. Zach, if you go to slide 19. So these are the provisions that will keep tax preparers busy for a while, as well as providing cash relief to a significant portion of our clients in the middle market, small to middle market. This has been a hot ticket item ever since the Tax Cuts and Jobs Act came out in 2017, was a qualified improvement property. This was what they called the retail glitch in the act. It's been a hot ticket item with politicians, but finally they issued the technical correction with the CARES Act. So just a little background, definition of qualified improvement property is interior improvements made to non-residential real property after the date when the property was first placed in service. However, improvements do not qualify if they are attributable to the enlargement of the building, elevators or escalators, or internal structural framework of the building. So if you're gonna put up new beams that support the second floor, that doesn't count even though you're doing work on the interior. So mainly they used to call these leasehold improvements qualified retail improvement property, qualified restaurant property, etc. Those definitions are no longer in place under the TCJA, and it's only qualified improvement property. But with this fix, it's been lobbied by several industries, including the real estate industry. So now these improvements are now considered 15-year property. And with that, you get 100% bonus depreciation on all of those improvements. And so that's going to be a huge bonus for a lot of taxpayers. The 100% bonus is going to be available through 2020, and then obviously through the regulation, it's going to be decreasing over the next few years to a lower percentage. Prior to this correction, we have been taking these items as 39-year straight line. So as you can see, when you go from 39 straight line to potential 100% bonus, it can be a huge benefit to taxpayers. With this qualified improvement property fix, they are allowing you to go back to 2018 and amend tax returns in order to fix this. And so this is going to be a huge item for taxpayers. And with that comes new guidance. Just yesterday, the IRS posted Rev Proc 2020-23, which provided procedures to file amended returns for partnership tax returns for 2018 and 19. Specifically, if partnerships were subject to the new partnership audit rules, those items had specific procedures, those taxpayers had specific procedures in order to file these amended returns. And one thing to keep in mind is that they're looking for the amended returns under that Rev Proc to be filed by September 30th, 2020. So that's going to be an item that we at Janover are going to be looking for looking through all our clients and advising whether or not they should be filing amended returns. Another way to, I guess, catch up bonus depreciation is to do it on your 2019 tax return. With that comes an accounting method change. It's an automatic change, but we're still waiting for actual guidance from the IRS. With the CARES Act, it got brought up quickly, went through legislation quickly, so a lot of clarifications need to come out, not just on qualified improvement property, but on several different tax items. This is going to benefit all businesses, not any specific industry. So that was a huge ticket item that's been debated for several years, and it's finally passed. Next up, if you want to go to slide 18, this is a section 163J, which was the interest expense limitation. It applied to entities or groups of entities with greater than $25 and $26 million. In 2019, it'd be $26 million. It limited interest based on what they call adjustable taxable income. So the CARES Act modified 2019 and 2020 to allow deduction of interest with a limit of 50% of adjusted taxable income rather than the 30%, which was under the Tax Cuts and Jobs Act. The one unique item with this has to do with partners and partners in partnership. Partnerships and partners in partnerships. There's special rules on elections. Basically, the increase to 50% doesn't apply to 2019 for partnerships, but there are several unique provisions that need to be taken into consideration for these partnerships. I'm not going to go into those now, but they are unique and they need to be identified because there are special elections for those. If you want to go to page 17. So with this, additional guidance came out with the CARES Act on Code Section 461L, which is the excess business losses. So losses for non-corporate taxpayers was modified under this CARES Act for 2018, 19, and 20. So under the Tax Cuts and Jobs Act, the law disallowed pass-through losses greater than $250,000 or $500,000 single or manufacturing joint on a personal tax return. So this was a huge item because you could have had a taxpayer that sustained huge losses and they were limited significantly. Those losses would have turned into NOLs for future years. But what this is allowing us to do is to amend prior year returns in 2018 or generate losses in 2019 and 20 and allow 100% of those losses to be deductible. And so that's going to be a huge benefit for a lot of taxpayers, especially as we sustain losses in 2020. Or we have opportunities to amend in 18 and take NOLs, which leads us to the next item, which is net operating losses. The one thing that changed, well, there's two items that changed significantly. And the first is the net operating loss taxable income limitation is repealed for 2018, 19, and 2020. So it removes the 80% taxable income limitation, and all NOLs are going to be able to offset income. So as an example, under the Tax Cuts and Jobs Act, if a corporation or individual had prior year NOLs and they had, let's say, current year income of $100,000, then they would be allowed to use $80,000, which is 80% of the NOLs, and be subject to tax on the remaining $20,000. So with this change, the taxable income is going to be zero essentially because they can utilize 100% of the taxable income as NOL, so $100,000 of NOLs to offset taxable income. So that's going to be another item where we're going to be looking to amend returns, but with losses, that'll lead into the last item, which is the CARES Act allows you to carry back NOLs now that arise in the tax year of 18, 19, and 20. It allows you to carry them back 5 years. So if you sustained a loss in 2018 and you happen to file an amended return, you can now go back to 2013. Same thing if you sustain a loss in 19, you go back to 2014. So there may be, I guess economically, these businesses have been doing pretty well over the last 4 or 5 years. So you would think that there is significant taxable income to go back to, depending on the business. And it's all about getting money to the taxpayers that are struggling now, whether it be due to, decrease in tax liability for their 2019 taxes, or going back and amending returns to get back taxes from the federal government. And it's all about, taking advantage. This CARES Act, with regard to a lot of these provisions, is all about getting losses, realizing these losses in a way where we can get some money back into the taxpayers. So the other thing is, we are still waiting for guidance on how the states are going to be handling these items. I believe just today or yesterday, there was something posted about New York State maybe decoupling from the 163J change under the CARES Act. So there's still a lot of unknowns, but there are significant opportunities for taxpayers to get funds back, money back, and to save on taxes. So these are all things that Janover is looking into for every single one of their clients. And you as a taxpayer really need to be aware of all of these changes and how it affects your cash flow in terms of taxes. I believe that is it. Zach, back to you.
All right, thanks, Luca. So we do have a few minutes here for questions. So I want to open it up with some of the questions that have already come in. If anyone out there has additional questions, please feel free to send them in. So the first question, is office rent an includable expense for CARE Act purposes?
Joe, why don't you take that one?
I had to first unmute. Okay. Yes, rent is one of the expenses that is an allowable expense. Yes.
Great. The second question that's come in, are private clubs eligible for CARES Act funding?
To the best of our understanding, no. SBA loans were never available in the past for nonprofits. The CARES Act expanded that to 501c3 organizations and 501c19 nonprofits. It's my understanding that clubs fall under the 501c7 area, and therefore they are not eligible.
Great. Next question comes in from Anonymous. Can an owner that gets their compensation through distributions, i.e. a K-1, and therefore is not included under payroll under PPP, apply separately as an independent or a sole proprietor in addition to the business application?
Yes. That can count as part of the payroll costs. An
And
independent,
so they would able to be.
in fact, that's the, I'm sorry, go ahead.
No, just part two, that would they be able to apply concurrently as well as an independent or a sole proprietor?
They're able to apply as an independent sole proprietor. Yes. In fact, that's the reason why other companies cannot use payments to independent contractors in their payroll costs, because the government recognized that independent contractors were going to apply for themselves. So the answer is yes, they can use that.
Perfect. From Jeff Cordova, he intends to apply for a PPP loan to cover his business employee payroll. He is structured as an S Corp and is 100% the owner. He does not take a salary. Can he include up to 100K of the business's profit to cover the owner income?
Unfortunately, the way I see it, no, because the income that you have must be in the form of salary or net earnings from self-employment or similar compensation. So what Jeff, I think he said his name was Jeff was asking, sounds like more akin to a dividend or a pass-through from an S corporation, which appears not to be eligible.
Great. From Jacob, is there any limitation on charitable organizations that can qualify for above the line deduction for individuals?
At this time, no, there's nothing in the CARES Act for any limit on what charitable organizations qualify.
Yeah, charitable organizations are typically 501c3, which was purposely added as eligible.
Another question that's come in: how is someone who's self-employed, who makes in excess of $100,000, but does not receive a regular paycheck, supposed to determine the amount to put on the application? And what supporting documentation needs to be provided?
Okay, so actually that's a multiple question. For a self-employed person who makes, I think I heard you say makes more than $100,000, but doesn't take regular payroll. You don't need to take a regular payroll as a self-employed person. That was pretty clear. The net earnings from self-employment is what's used. But you are allowed to include other benefits. So if your company is paying for your retirement benefits, if your company is paying for your healthcare costs, those should be allowed in excess of the $100,000 cap that is placed on your compensation. So you should be able to use all of those. And what kind of documentation? That seems to be more lender by lender. We're finding that some banks ask for certain documentation, others ask for other documentation. I think at the very least, you should be expecting to put something probably like your tax return. Maybe you have a Schedule C. That might be your proof of your compensation. You might also want to pull together the payments that you made for health insurance. At this point, I don't think you need to go as far as sending premium statements. But if you had something that showed in your ledger as some sort of health insurance expense, that should be okay. Of course, it can be audited by the bank. It can be audited by the SBA in the subsequent process. But pulling together that documentation, you'll have plenty to be putting together anyway. They ask for a lot of information and a lot of questions.
I have one client who's applying, and we're using the top line revenue off of Schedule C to support that.
Yeah.
Perfect. Question from Ken. If a company uses the PPP SBA proceeds for a non-allowed expense, do they lose that portion of the grant as a grant, or do they somehow get penalized?
Yeah, my reading on that is that could make the whole deal go bad. So you could have to possibly return the whole amount. So you're only allowed to use it in the one of 6 ways. Okay, for your payroll costs, which, as I said, include the benefits, for rent, for utilities, and utilities is a broad category, by the way. And that's a broad category to include electricity and telephone and internet, etc. You can use it for your healthcare costs for your employees. You can also use it for the healthcare costs of former employees who are on leave. And the other 2 ways you can do it are on interest on mortgage debt in your business and interest on indebtedness that was incurred other than mortgage prior to February 15th of 2020.
Since
if you use it for something else, I think that you could be jeopardizing your entire loan.
Let's go further with that. Since only 25% of your proceeds can be used for other items other than payroll costs, you have those 5 other categories that you could use. While you can only get a grant if it's paid out in the first 8 weeks, you have through the end of 2020 to use these proceeds for the other areas. So as long as your business is operating to some extent, I find it hard to believe that you will not be able to use these proceeds in a manner to keep the rules of the loan intact to one of these 6 categories. Not let alone, we think with proper planning, you should be able to get the vast majority of these payments, unless you have no payroll, to support yourself for the grant provisions beyond even just getting the loan. But as Joe said, you have to use it for one of these 6 categories. You cannot go outside, and you could jeopardize everything by doing it. Maybe consider it a fraud even. You'd have to I advise you to speak to your counsel before you do that, or just don't do it.
Yeah, so as you may recall, when I was speaking earlier, we recommended that separate account And that will probably help in the confusion, if there is any. So just knowing that that money can only be used for those categories will help you if you keep it in a separate account. So we believe that.
That's very good advice. And I think that's been pretty consistent advice as well from the Janover team. We have time for one last question. And this is a relatively broad question from Ken. To paraphrase a bit, for restaurants and other seasonal type businesses, when trying to calculate the average payroll per month, is there any special consideration that needs to be given?
Yes, there is. First of all, I heard you say seasonal business. A restaurant, if there's a particular restaurant that's seasonal, then they would fall under that category. But I don't want to make it sound that this is applying to all restaurants. Seasonal businesses do have a special rule that instead of using the past 12 months, they're allowed to use a special 2-month period of January 1st through February 20th in working up their payroll costs that make them allowable for the loan. So as I mentioned earlier, you're going to multiply 2.5 times your monthly payroll costs. The seasonal businesses are allowed to use the first 2 months of 2020 instead of the year back. That's the special rule.
Perfect. All right. Well, with that, I think we're going to close up here. I want to thank Mark, Joe, Mindy, and Luca for doing such a great job. And I want to thank everyone out there for attending. If you have any questions, please reach out. There are a lot of complicated issues to deal with. So to summarize all of the advice from today, talk to your professionals, talk to your Janover representative, ask questions. We're here to help. So again,
I want to add one more thing. Anyone whose business is being affected from a revenue standpoint, you should be doing a rolling 13-week projection and using certain assumptions on revenue based upon prior year as a percentage, so that you should be alternatively breaking out your disbursements between those categories that must be paid, such as insurance and your wages, obviously, to the extent that you're retaining employees, and those expenses that can be extended. Because it's more than just these loans and the tax rules that we need to be following here. We need to be focusing very carefully on our business to make sure that we are maximizing our efforts to, because we don't know how long this is going to go on for. And so we need to manage our cash flow very carefully.
All right, a very good way to close it out. All right, thank you, Mark. Thank you, everybody else. And with that, we will see you on our next webinar. Thank you so much.